Yeah, management confidence is something that does really hurt a stock because most stocks, institutions are the main holder. Retail is not a factor in real companies like Sarepta, but retail is only a factor in stuff like, quantum computing, INMB, Sava. Like, most of the time retail is not, that relevant. But in this case, if there's no institutions left to buy the stock, retail takes over and they need to invent reasons to buy stock. And most of the time, retail just wants the 100x. They want the moonshot. They want something that will give them financial independence. But of course, there's no such stock.
Like, what's the biggest mistake that you see biotech companies make when they think a drug should work, but it doesn't?
I don't know if there's a lot of those. I mean, I think that probably the biggest mistake is like when you're a small company and you don't want to give up. That happened a lot with, say, Cassava and others. Like, there's pride of authorship. I mean, if you make a drug and you design it and you say, this is mine, it's really hard to walk away from it often. And I think you have to be twice as critical. So I invented this drug called RE024, I think. And that was the code name. And I was really critical of it. In fact, before I left the company that I started, I basically said that this drug's not going to work. It needs to be redone. But I think the problem is that there's this agency problem, owner-agency conflict, which is the first thing you learn about in any business textbook, which is that the managers of the organization and the owners of organization have two different goals. And this is a problem that's been ever present in business. The goal of the managers is to perpetuate what's best for them using the organization. The goal of the owners is to perpetuate what's best for them using the managers who work at the company. But so often the managers say, well, what would be better if we gave up on phase one and went back to the drawing board and did a whole bunch of science, our stock would take a hit and we'd have no news for 3 years. But it's a lot more exciting to potentially do, just rush forward with the data, and maybe we get lucky, but at least we get our salaries and things like that. Nobody's going to fire us.
So this is the database. Now, you go into a list of 50 million people, and you find that, it's the same story every time, and nobody ever learns, but we did this with Cassava. I feel like I'm repeating myself. You go into this 50 million person database, and you sort it, and you say, which group of patients of these 50 million, sorted by ICD-9 codes, okay? Whatever, ICD-9 or ICD-10. Sort it and tell me which diagnosis of patient had the biggest decrease in dementia given an intervention. You could do this with SQL. And boop, 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 out comes out. It turns out that people who took TNF-alpha inhibitors that had rheumatoid arthritis versus people who did not take TNF-alpha inhibitors who had rheumatoid arthritis had a decrease in dementia. Now, again, you have to be half to think that this is causal. Just because you see a list and you sort it, you can sort it, you can press this button. There will be, by definition, there will be a winner and a loser. There will be a situation where it looks like it's causing Alzheimer's, and there'll be a situation where it looks like it's removing Alzheimer's. If you score it from 1 to 50 million, you will get that, or whatever, how many ICD-9 entries there are. And this is called multiple error correction. It's a simple concept in statistics. For example, Bonferroni correction. I gave a talk about this at Harvard 10 years ago. It is the most common mental error people make. They ascribe causality where it doesn't exist. If I looked at a histogram of my live streams to try to figure out where the most viewers watched, what minute and what second, and I see that at 3 minutes, this was the time that most viewers watched, and I look back at the content to see what they liked the most about the content, and I tried to recreate that content, that's probably more causal than this. It was more like if I flipped a coin 10 million times and I found the distribution, the stretches of times in that coin where I was above 50%, I would say those are my good times and I need to do those at that exact hour. Or if I looked at pi and I tried to find a stretch of digits. In fact, there's a proof that says any stretch of digits you can imagine, like 666, will occur in pi. In fact, 10 sixes, 50 sixes, it'll eventually occur. So, we are often fooled by randomness, is my point. And, this study convinced some people that maybe TNF alpha inhibitors reduce Alzheimer's, even though it's a retrospective study that has no causal inference. This has been disproved many, many times. And I'm going to show you the main disproof of it. But this was what started all this nonsense.
One of the things you learn about me is that I work harder. I'll outwork anybody, even if they're smarter than me, which I think my girl is smarter than me. But I will stay up all night reading every paper, every textbook. And I'll show up in the morning and be like, well, what do you think about Jones's work? And how about Bourbaki work in 1847? Doesn't it that point to da-da-da? And they'll be like, damn, the fuck? How do you know so much about this? I'm like, I want it. I want it more. I don't have any time expectations on any of my stocks. I don't know when any of my stocks will work because I just don't think it's knowable. Like it's hard to tell when markets will decide that you're right. Whenever you make a trade, you're basically saying, I'm right, the market's wrong, right? And because there is a delta in opinion, there has to be a closing of that delta. But you don't know what caused the delta in the first place. You just looked at the stock and said, I think they have it wrong. I hate it. They love it. Or I love it and they hate it. I'm going to wait till it's the other way around.
There are Gary Kasparovs out there. The whole market's full of them. They get more capital than you. It's a very weird dynamic because they have so much capital, it really is bizarre. Unlike chess or any other binary game, you go to a chess tournament. I don't know if you guys have ever done this, but there's like the best ranked players sit on that far left table. I'm usually there. No, I'm usually somewhere over here. Yeah, I think this is like Swiss ranking or something like that. In every round, by the second or third round of the chess game, if you're 3-0, you're over here. And you play the other guy who's 3-0. The guys who are like 1-2 or 0-3, they're over here on table 19. So it looks like, okay, well, there's only 16 people here. Someone's going to win. I feel like I have a 1 in 16 chance. Stock market doesn't work that way. It's very pyramid driven. So here at the top is Citadel, Jane Street, Millennium, Point72. They have all the capital. Maybe it's an inverted pyramid. You're down here with your Robinhood account. And it takes 1 million of you, because there's only a couple of them. It takes 50 million Robinhood customers to challenge 5 hedge funds. And they will take your money. Not all the time, but usually the capital will flow from here to here. Jane Street made $20 billion last year. Citadel, whatever, 10 billion, et cetera, et cetera. Retail could have even made $1 billion because stocks are generally rising, or even $10 billion. But they underperformed the S&P. And they took way more risk. So when the market turns, they'll still make money. Jane Street makes money in any market, for example. It's a rigged game. I mean, basically, it's a rigged game. You're not going to win, especially if you're not doing 80 hours a day studying investments. I mean, it's as good as likely as me beating Hikaru. I haven't spent my whole day. I wouldn't even. Why do you want to be in the market? Normies shouldn't be in the market. Even index funds are bad, in my opinion. Just do it every year, Peter. You'll be rich. Trading is zero sum, in my opinion. In fact, I think trading is negative sum. You think the S&P 500 goes up over time. Why? Because it has gone up over time. The problem is that's not a good inference to make. Why? Because just because something has happened doesn't mean it'll keep happening. In fact, it could do that tomorrow. You don't know. You don't know, Sway. You have no clue. Second, we got a little thing that presses this down called inflation. And you also don't know what this inflation will be. So your real return looks something like that. And then we got another thing that presses us down called taxes. So if in the case you do win, you're going to take a little bit of that too. Real returns for the S&P are somewhere around 2% net of all this. And that's the best case scenario with the best managed country. Other countries, they cancel the currency. They cancel the stock market. You just have to be around a while. You get 10 nice years over here. This was the 60s to the 80s. 20 nice years of underperformance. The average person, listen, focus on the things that make you happy. You want to make a lot of money, find a trade, a business where you can make a lot of money. The stock market is one such business, but you better be dedicating your whole life to it. If you love the market and you love investing, look at chess. Okay, let's not pick on chess. Let's pick on backgammon. There are people who play backgammon as much as chess and poker. Why would you spend your life looking at some plastic cards or some wooden pieces or throwing a dice in a backgammon game? It's because you love it. You know, you have an admiration for the beauty of the game. You just, some people call it the chess bug. Kids get bitten by. You just want to play. I went to Hunter College High School. I used to play chess all day in the hallway. Not even go to class. I just play chess. It's fun. You know, if you love the market, you love stocks, you love the action, you love the businesses, you work on Wall Street, man. It's great. But you want to participate from home? Okay, it's doable. But you really got to get into it. You can't have some other job. This is your job, right? You want to be serious about it? I'm just a grandmaster on the weekends. It doesn't work that way. Yeah, you got 2 jobs. You got no time for investing. I don't look at the past, okay? We can't change the past. So the only question we're asking, whether we're up big or down big in a stock, is what's the return going to be right now? So if I buy a stock for 50 and it goes to 17, and I do the math and I feel like it's worth 17, you have to sell it right away and put the money into something more productive. But if you do the math and you think it's worth 50, you know, you can stay in. If you do the math and it's worth 5, obviously you have to get out. And most people don't want to be wrong about a stock, right? Nobody likes to be wrong. Being wrong is one of the most punishing things in the world cognitively. And you have to train yourself to almost love being wrong, because you will be right, especially if you know what you're doing and you're smart. That's not the hard part. It's being wrong that's hard. And you have to try to associate being proven wrong on something with this good feeling, which is very hard. But if you ever had an argument with somebody, even about something stupid, a lot of people refuse to give up, right? They'll dig themselves into that argument over and over again just to make sure they're right. Like a good example was, and we have to add Keston's to our intro video. But basically, this is a guy who, when we got the press release or the presentation for Immune in the middle of the night, and we shared it, Carl Kestens was like, "No, that's a deep fake." I think laughing like that makes you get a heart attack, so I'm not going to laugh like that. But the guy literally thought it was a deep fake. A deep fake? Man, it's a corporate presentation with 60 slides. You think we deep faked it? It's on Immune.com. It's not it's done in the middle of the night. Why would someone do a deep fake? It's on Bloomberg. The guy's like, "No, it's a deep fake. Can't be real. My drug works. I don't know what that is. My drug works." Being wrong about even a simple thing is really, really, really hard for everyone, including me and including you. And you just have to be better at it and, lose the humility, or gain some humility, lose the arrogance, and accept if you have. And this is why a lot of investors, especially new investors, lose all their money, is because they fixate on one stock. I mean, how many people have you met online or read about online that are just like, "Oh, I love GameStop," or "I love AMC," or whatever stock? Doesn't matter what stock it is. It could even be Palantir. And these people are just they're one-trick ponies. The problem is the probability of you being right about everything is 0. It's 0%. You will not be right about everything. Doesn't matter who you are, what career you have, Warren Buffett, you will not be right about everything. And you just have to sort of come to terms with that. So if you're wrong about a stock, you have to get out. And that's it. And it's painful. But, you know, you got to grow up. If you don't want to face facts, you'll be staring at a zero in your stock account. And this is why you can't go all in on a stock practically ever. Because eventually you're going to be wrong. And your risk of ruin is 100% if you have a 100% position. Eventually, the Reaper, you know, you might get a double out of Sarepta here. But what happens when the next Sarepta happens? Eventually, you will meet your maker. This is kind of genius. I have to admit, I should have done this, to be honest. But you got to think quickly and act quickly and have a good banker relationship. So basically, you know, let's say you're big hedge fund one, not big, you know, whatever. Doesn't have to be big. Hedge fund one, hedge fund two. Hedge fund one is short 1 million shares of INMB. Hedge fund two has no position. Nobody's long INMB, right? So that's normal. You see the stock go up from what, 6 to 14. You call up, this is a telephone, their banker or their CFO, and you say, look, I'll buy 3 million shares at your last close, $6.30. And they say, whoa, wait a second. You know, we're about to announce Alzheimer's results on Monday, right? And they say, yeah, of course we know that. So you want in on our stock right before then? Yeah, the market's not that liquid. We want to buy 3 million shares at 6:30. And they say, well, look, you know, the stock's trading at 14 right now. We can't sell you at 6:30. And they say, take it or leave it. You don't want the money? That's fine. You want the money? They check, they say, they put the guy on hold, and they say, of course we need this money. We're about to announce a failure. We need to survive after this. So let's raise some money. We'll take it. We'll sell you 3 million shares at 6:30, but you know, we're not going to tell you what the data is. The hedge fund says, oh, it's no big deal. We'll see what the data is on Monday. We have a good feeling about it. So hedge fund one had no position before. They get 1.5 million shares. Hedge fund two now gets 1.5 million shares. They're actually long. But all the while, they're allowed to short. They send it right back down to 6. And all the money from 14 to 6 is free money. So if they were able to short, I don't know, let's say they shorted it at 12 on average, some at 14, some at 10, some at 8, they made $18 million in a day, which even if you're a $1 billion fund, 18 million split between the two of them, 9 million, hey, that's 90 basis points. That's probably one of your best days of the year. You never got material non-public information from the company, right? You don't want to know, don't ask, don't know, don't tell. I'm free to trade the stock. Only information we have is the company is willing to take stock at $6.30, which if you had great data coming out tomorrow, why in the world would you do that? You would sell 50 million shares at $60. They raised 300 million. Well, that's even more than that. So it's over. The dark blue line is NVIDIA, okay? And NVIDIA, this is like March 18th, 2020 for NVIDIA at 2:02 p.m. So you guys are asking lots of questions while I'm trying to show you something. It's March 18th, 2020, 2:02 p.m. And you're looking at the last 30 minutes of NVIDIA. Do you see these little lines around the NVIDIA line? These little lines around the NVIDIA, the cam is intentionally in the way. I did it to block it in a certain place. So the little lines around NVIDIA are something where I actually don't want to talk about how I did it, I guess, but I searched through the entire history of the entire stock market. And these are the closest fits to that exact chart pattern. And you can see they match the shape pretty well. So in the history of all of investing, Halliburton 2000 had the exact same 30 minutes. HXL, I don't even know what these stocks are, by the way. I know ADI is Analog Devices. And these are the exact same almost the exact same chart pattern. So for any stock, using my new system, you can type in the chart and the ticker, and you get the closest matching stock chart. Okay? So it's you know, I'm not going to go into the technical explanations of it. You guys, if you're interested at all, you can do that yourself. But the basics are that it's the closest possible matching. It's over any amount of time you want, Islanders. So you could do this over 1 second, 5 minutes, 5 years, whatever you want. You want to say, show me all the stocks that are the same price, the same shape of price. And you could do this with volume. You could do this with candles. There's any self-similarity or similarity. Okay, so why do this? One question is, would it predict anything at all? And that's kind of the bigger question. And that's why I moved my camera. So the orange line is what actually happened to NVIDIA. So this is like the way to actually do technical analysis, quote unquote, is called statistical arbitrage. So this helps you dispense with technical analysis. This helps you prove that TA is bullshit. Because why? Well, look what actually happened for the next 40 minutes. These stocks had perfect correlation, right? Up until this time point, which I chose arbitrarily. Then right after that time point, even within 10 minutes, they were all divergent. They're all different. 10 minutes, and by 20 minutes, they were even further apart. I know, Epic, you're actually watching history being made, and you realize it, but a lot of other people don't. So what's the predictive value? Well, you could see that statistically. You could say, show me within Euclidean distance of X, what is the average expected return? And it should be 0, right? So when you look at a stock that is quote unquote breaking out, you match that pattern with history and say, well, history says there's actually no return here. And I think that's going to be something that's really helpful. The searching throughout the market's history is very technically difficult. It requires terabytes of RAM. But this will show you live, imagine this same chart, but live as the chart is being drawn, it shows you the future possibilities based on the past. I wouldn't call it fractal. And you basically can see like, okay, in 1983, IBM did the same thing. In 1995, Microsoft did the same thing. In 2003, Exxon did that. And, that's the kind of system. I think TA stopped working in the late 80s, maybe early 90s. So we'll be putting this on Godel. It basically requires a supercomputer or data center to run. But I think that, using this kind of system can really be powerful because 1, it can dispel some myths in your head. But 2, if there is real signal, you can at least see it. Whereas instead of guessing about is there signal, you can see it. And you can just add this to the normal chart library, right? So you can just add it to the chart library. And in fact, like pretty simple. So imagine you have this. This is what I was thinking for the interface. Okay, so this is obviously pretty basic, but just getting it to spit this out took me about 2 weeks. So you could have this be like, I don't know, you click this and maybe another box pops out where it says something like n equals 100, mean return 0.01 or whatever, and standard deviation 0.05. So you can see there's no signal there for the top 1,000 matches. And maybe you do the top 1,000 matches, same thing, etc. And what's cool is this is real time. So as the next candle draws, all of these will change. This might go up, this might go down, this might go up. These will all change. You know, this will become some other stock that matches it better, etc. And you could adjust your window size. If you want 30 candles, that's fine. If you want 40 candles, etc. And, you know, I think that what's important to have in life is data. You know, if you are guessing and are hoping to pattern match from your history and your mental history, yeah, you could do any time interval you want. 1 second, it wouldn't make much sense, but you could do that. There should be no predictive power, theoretically, but there's also